Is a return to the gold standard inevitable? Well, my next guest says yes, and he also thinks it could push gold to $10,000 an ounce. He's John Butler, the author of The Golden Revolution, and he joins me on the spot. All right, John, thanks so much for being with me on the spot today. Tell us a little bit about yourself and what led you to write The Golden Revolution.
Well, my background is as an interest rate, currency, and commodity strategist. And I did that job for quite a number of years at major investment banks around the world. And as the years went on, in particular through the 2000s, I grew gradually less interested in interest rates and more interested in commodities, for the simple reason being that interest rates on average trended lower. And at some point, they might eventually reach zero. And if they did reach zero, then at that point, where are they going to go? And so I did some theoretical research already early in the 2000s about what would happen to the world of interest rates as they approach zero. And one of the implications was that real assets, commodities, including, of course, precious metals, would do particularly well in that sort of environment. And indeed, that's exactly what we've seen on average in recent years. And it remains my primary interest and was a key reason why I chose to write a book about it, about how ultimately unconventional central bank policy and zero interest rates leads back to a gold standard.
All right, John, we'll go deeper into the gold standard in a bit. But right now, do you think if gold hit $2,000, it's a bargain?
Well, look, it's a matter of perspective. To some people, the gold price is already high, and that's fine. To others, high relative to what is the key question. High relative to what? What are you comparing it to? Are you comparing the gold price to the gold price 10 or 20 years ago? Well, okay, I'm not saying that's irrelevant, but let's look at the gold price relative to other things that have evolved over the past 10 or 20 years, such as the money supply itself, the level of interest rates, the amount of uncertainty in the world, the amount of risk in the world, the shrinking size of the US economy relative to the world. There are many, many factors which justify a substantially higher gold price today than what we observed 10 or 20 years ago. And at the rate we're going, everything I just mentioned, from money supply growth on the one hand to more qualitative issues of credibility on the other, all support a rising price for gold.
All right, John. So in your book, you state how the fiat dollar reserve standard really contributed to the 08-09 global credit crisis. How so?
Well, this is one of the more controversial points in my book. Now, many people will focus on the structure of bank regulation, for example. In some cases, they claim the lack thereof. I sometimes find that a difficult argument because the financial sector is arguably the single most regulated industry in the world. So whenever someone says, oh, it was a lack of regulation, I immediately require them to at least consider just how regulated it in fact is relative to most industries. But fine, moving along. I mean, the thing is that when the money supply is available to a central authority to expand, to increase, to manipulate, for lack of a better word, in response to changing conditions, naturally there's always a temptation for those in power to think that they can expand, they can increase, they can manipulate in a way which adds to the economy, which creates wealth somehow, which results in something better than what the money market itself would have created. Now that, when you step back from it, is a rather hubristic claim, number one, and number two is demonstrably, in practice, wrong. You can look back at everything that's happened since the US closed the gold window and went off the gold standard in 1971. And there is not a single, and I stress this point, there is not a single financial crisis that has occurred following a period of stability in the money supply. They have all invariably followed significant increases in the money supply. That should be telling us something. Were we not on this fiat dollar standard, which allowed these increases in the money supply, but rather something more stable, we wouldn't be having these crises.
So, John, what do you say to critics who say, look, when we were on a gold standard, we weren't really better off? Between 1850 and 1919, we saw 16 recessions. They also say that because of the gold standard, the Great Depression may have been prolonged. What's your answer?
Well, it's twofold. First of all, I would take issue with those who claim that recessions are automatically a negative. I mean, I hate to say this, but capitalism and recession sort of go hand in hand. If you're going to allow a free market to work, you're going to have to allow for some degree of volatility in the business cycle. And indeed, if you're not going to allow policymakers to bail out either the financial sector or the economy more generally by expanding the money supply now and again, then yes, you'll occasionally have a sharp downturn. The difference is the following. The sharp downturns, when they occur, they will occur in an environment in which, in fact, the capital stock and companies, when they do go bankrupt, rapidly reorganize, restructure themselves, and move forward, incorporating new technologies, moving labor to where it wasn't efficiently used to where it is efficiently used. That's called creative destruction. It's a good thing. It goes hand in hand with healthy capitalism. So that's the first point. The second point goes a bit farther than that, and it's the idea that somehow a rigid money supply itself or a gold standard causes downturns. Well, if that were true, then of course it would cause upturns as well. Or looked at the other way around, if an elastic money supply, that is one that is increased in response to a downturn, doesn't solve things like the Great Depression, which it didn't, okay, then is it really the panacea that policymakers claim it is? Or is it, in fact, perhaps also the contributor or even the cause of the occasional severe downturn? Could it be that economic agents take excessive risks anticipating a bailout? Could it be that that's in fact part of what happened this time round? Monetary policy authorities are never willing to ask that sort of question, and for obvious reasons. It's an embarrassing and potentially disturbing one.
So, John, what do you say when people suggest that the gold standard prevents the Federal Reserve from expanding money supply and really creating stability?
Well, I say they're putting the cart before the horse. I mean, if having a stable money supply prevented the crisis in the first place, then how on earth can you claim you need that power to deal with it in the event it occurs? It's kind of like gravity. Imagine that a stable money supply is like gravity. Well, look, if you go up in a hot air balloon and you overinflate it and it bursts and you collapse down to Earth, then yes, some might claim that gravity complicated attempts to save the balloonist who died. But to blame gravity for the crisis is entirely misplaced, and that's the flaw in the Fed's logic in this case.
All right, John, let me back it up a second. Do you believe that we need a Federal Reserve?
I think central banking is ultimately optional once you move back to a gold standard. I'm not saying that around the edges, the functions of a central bank are completely useless. Certain aspects of bank regulation, I think, are perfectly reasonable, but modern central banking in practice is arguably counterproductive and is certainly unnecessary in its current form in the event that a country chooses to adopt a stable money supply, which by definition you do in the event that you choose to peg your currency to some gold exchange ratio.
Okay, John, but do you think that the Fed and a return to the gold standard could really coexist? Can there be harmony?
Well, they did coexist. They coexisted from 1913 until 1971. Now, they didn't coexist without certain strains in the relationship, to be fair, but they did coexist. And in fact, you could argue that notwithstanding the occasional crisis during that period, the Federal Reserve, for the most part, did a respectable job, and that it was in fact the fiscal authority in the US, in particular in the mid to late 1960s, which followed policies that were just so clearly unsustainable. The rest of the world no longer took them seriously, called in their reserves, i.e. chose to exchange their dollars for gold, and brought down the Bretton Woods system as a result.
So John, why gold? Why not SDRs?
Well, I mean, the SDR proposal, which of course comes from the issuer, as it were, of the SDRs, the IMF. I mean, on paper, the SDR proposal is reasonable in the sense that you say, let's have a single global currency which will facilitate the integration of the global economy and make cross-border balance of payments transactions just that much easier, and will prevent countries from abusing their ability to manipulate their currencies. Again, on paper, that sounds nice, but it also sounds very much like what sounded nice on paper in the 1990s when the euro area was being put together. The SDR idea is nothing more than a global euro. It's the idea that somehow the whole world can come together and have a single currency, and that can somehow work wonders for the global economy. Again, in theory, it sounds nice, but in practice, it would be a disaster. And the idea that countries that run the most stable finances, the most credible policies, they would be the ones paying for the mistakes of others. There's no way they're going to go along with it. The whole thing would break down as soon as it was implemented, and I don't take it seriously. What makes it is that those who try to abuse the system find they are immediately, I stress this point, immediately punished by financial markets, by the golden vigilantes, if you will, who will come out and discipline the system in the financial markets. None of the shenanigans that occur under fiat currency regimes will be possible in the event that you truly go back onto a gold standard. So the benefits for those who choose to take a look at history are obvious.
All right, John, I'm going to hold your thoughts right there. We'll have part 2 of this interview coming up later in the week, where I'll be challenging you on some counterpoints to a return to the gold standard. But thank you for joining me. We'll be back.